Hello, good evening, dear students. In this module, we are going to discuss one problem on admission of partner. You all know the basic concepts of partnership, number of partners to be admitted, and partnership deed, etc. etc. Here in this module, we are going to discuss the problem, that is the accounting procedure. How we are going to prepare necessary accounts at the time of admitting a new partner. According to this problem, there are two partners A and B sharing profits in the ratio of 3:1. The balance sheet is given as follows. We have stock, prepaid insurance, debtors, cash, machinery, buildings, furniture. You all know that asset side consists of current assets as well as fixed assets. Liability side we have current liabilities and partners capital. The balance sheet total given is 95,000. Now come to the adjustment. The new partner, Mr. C, is admitted as a new partner by introducing the capital of 20,000 rupees for his 1/4 share in future profit. So, in future, Mr. C is going to share 1/4 of the profit. Come to the adjustment. The very first adjustment is stock to be depreciated by 5%, furniture to be depreciated by 10%, buildings to be revalued at 45,000. The provision for doubtful debts should be increased to 1,000 rupees. So these are all the adjustments given. Past journal entries, prepare revaluation account and balance sheet after admission. Now we are going to discuss only the preparation of ledger accounts. Okay. The first ledger account to be prepared is revaluation account. Second one, capital account. Third one, cash account. And fourth one, balance sheet after admission. Balance sheet after admitting Mr. C, the revised balance sheet. Now, you must know the nature of revaluation account. Revaluation account is a nominal account. We follow nominal account to prepare revaluation account. You all are familiar with the rule of nominal account: debit all expenses and losses, credit all incomes and gains. Okay. So now let us go to revaluation account. So what is the purpose of preparing this revaluation account means? At the time of admitting new partner, the existing partners will revalue the assets and liabilities. The main motto and main purpose is the new partner is not entitled for any profit or loss in the old business. So, in the existing business, what are all the profits and losses? That will be shared only by the old partners, not by the new partner. Okay, so that is the purpose of preparing revaluation account, and the revaluation account profit and loss will be shared only by the old partners in old ratio. In this problem, the old ratio is given 3:1. Now come to the first adjustment. Stock be depreciated by 5%. Stock given in the balance sheet is 10,000 rupees. Okay, 5% depreciation. You all know very well that depreciation is a loss item. Debit all expenses and losses. So, revaluation account debit side to stock account 500. You have to find 5% on 10,000 rupees. Like that, furniture 10%. So, on furniture value 6,000 rupees is there. We are calculating 10% depreciation, which amounts to 600 rupees. Okay. And third adjustment, building to be revalued at 45,000. As according to the balance sheet, given balance sheet, the building value is 30,000. Now the revised value is 45,000. So there is an increase of 15,000. It is very clear that the building revaluation, that is the revised value of building, has profit. So there is a profit of 15,000 on revaluation, which is to be credited to revaluation account. Credit all incomes and gains. So we have credited the profit. Now the net figure, the net amount is transferred to old partners in old ratio, A and B in their old profit sharing ratio. So 13,400 is the profit we are getting. That amount is divided among partners A and B. Okay. Now next we will go to capital account. Regarding capital account, we are transferring the balance given in the balance sheet. As per balance sheet, partners capital is given 30,000 and 20,000 to A and B. So balance sheet in capital account credit side, by balance brought down. In capital account credit side, by balance brought down. We are entering the opening balance. Whenever you prepare capital account, the first step is to bring the opening balance to the credit side of the partners. So capital account credit side by balance brought down. Simply you are entering the capital given in the balance sheet. So 30,000 and 20,000. C is the new partner, so there is no opening capital. Next, you should check whether there is general reserve or profit and loss, but in this problem it is not given, so leave it. Now we have revaluation profit 10,050 and 3,350. That should be credited by revaluation account 10,050 and 3,350 to old partners. Right? Next, according to the adjustment, Mr. C is the new partner. He introduces 20,000. So he is bringing cash to the business. Cash account debtor to C's capital account. So by cash account, 20,000 in C's column alone. Next, there is no other problem here. We don't have any other adjustment. Okay, all the adjustments are clear. But fourth adjustment, the provision for doubtful debt should be increased to 1,000 rupees. Actually, in balance sheet we are given 8,000 minus 500, 7,500. Already there is 500. Now the provision is to be increased to 1,000 rupees, so another 500. That is debited in revaluation account. I hope you are very clear in revaluation account. We have 3 loss item and 1 profit item. And now capital account is also closed. There is no other item. Simply it is balanced. The closing balance we have 40,050, 23,350, 20,000, which is the closing balance. Always this closing balance should be posted as the opening balance after the completion of this capital account. That is, when after the total, opposite side we have to enter the opening balance by balance brought down. We should enter the opening balance. So it is 40,050 and then 23,350 and next 20,000. This is the opening balance for the revised balance sheet. Okay, this is the opening balance for the revised balance sheet. Now capital account is over. Cash account. Regarding cash account, in the given balance sheet asset side we have opening balance that should be posted to balance brought down. To balance brought down 18,500, that is posted on the debit side. Okay, now again you see wherever we have cash transaction, here we have Mr. C introduced 30,000, that is to be entered. After entering that, simply the account is closed. Simply the account is closed. So 38,500 is the balance of cash account. So cash account is over. Now let us come to balance sheet. When we prepare balance sheet, you all go to the problem asset side. Asset side, the first item stock. As per the balance sheet it is 10,000. Now we have to deduct the revaluation loss. So 10,000 minus 500, it comes to 9,500. Next item as per the balance sheet is prepaid insurance. That amount is posted as such. Debtors 8,000 minus 1,000. 8,000 is the opening balance. Already 500 is deducted. Now another 500. So totally 1,000 rupees is deducted. So we have in the outer column 7,000. Next item is machinery. In between we have cash. Cash 18,500 is given. Now revised balance is 38,500, that is posted. Machinery, in the given balance sheet we have 22,000. I think there is no adjustment for machinery, so the same figure is posted again. Buildings, 30,000 is given in the old balance sheet. Now the revised value is 45,000. Furniture, after depreciation it comes to 5,400. Come to the liability side, salary due, creditors, okay, that remain as such. Capital, we have closing balance as we have prepared here, 40,050, 23,350, 20,000. So after entering everything, our balance sheet is getting tallied for 1,28,400. Yes, I hope this problem is very clear to you. Please go through the problem all of you and revise it. Okay, thank you.